Welcome to Cortburg Speaks Retirement, an audio podcast about investing in the stock market, financial planning, money management, and retirement planning. Each Wednesday, we help investors at all stages of life learn how to potentially grow and preserve their money from first job through retirement. Now here's your host, Miguel Gonzalez.
Good morning and welcome to the Cortburg Speaks Retirement audio podcast. On this week's audio podcast, I share the 6 potential 401k rollover pitfalls and how to avoid them. You're about to receive a distribution from your 401k plan and you are considering a rollover to a traditional IRA. While these transactions are normally straightforward and trouble-free, there are some pitfalls you'll want to avoid. Number 1, consider the pros and cons of an IRA rollover. The first mistake some people make is failing to consider the pros and cons of a rollover to an IRA in the first place. You can usually leave your money in the 401k plan if your balance is over $5,000, at least until the plan's normal retirement age, typically 65. And if you're changing jobs, you may also be able to roll over your distribution to your new employer's 401k plan. Though IRAs typically offer significantly more investment opportunities and withdrawal flexibilities, your 401k plan may offer investments that can't be replicated in an IRA or cannot be replicated at an equivalent cost. An IRA may give you more flexibility with distributions. Your distribution options in a 401k plan depend on the terms of that particular plan, and your options may be limited. However, with an IRA, the timing and amount of distributions are generally at your discretion until you reach age 72 and must start taking required minimum distribution RMDs in the case of a traditional IRA. 401k plans offer virtually unlimited protection from your creditors under federal law, assuming the plan is covered by ERISA. Solo 401ks are not, whereas federal law protects your IRAs from creditors only if you declare bankruptcy. Any IRA creditor protection outside of bankruptcy depends on your particular state's law. Also, required minimum distributions from traditional IRAs must begin by April 1st following the year you reach age 72. However, if you work past that age and you're still participating in your employer's 401k plan, you can delay your first distribution from that plan until April 1st following the year of your retirement if you own no more than 5% of the company. Also, 401k plans may allow employee loans. IRAs cannot allow loans. Most 401k plans don't provide an annuity payment option, while some IRAs do. More 401k plans may begin to offer annuities because legislation passed in 2019, the Setting Every Community Up for Retirement Enhancement, or the Secure Act as we know it, has made it easier for employers to offer annuities as part of the plan. You can also take a lump sum cash distribution, but keep in mind that income taxes will apply, and if you're under age 59 and a half, the distribution may also be subject to a 10% early withdrawal penalty unless an exception applies. Depending on the amount of the distribution, you could also end up with a sizable tax bill. So that's 1. Number 2, not every distribution can be rolled over to an IRA. So again, number 2 pitfall is that not every distribution can be rolled over to an IRA. For example, RMDs, remember required minimum distributions, cannot be rolled over. Neither can hardship distributions or certain periodic payments. Do so and you may have an excess contribution to deal with. Number 3 pitfall, use direct rollovers to avoid 60-day rollovers. While it may be tempting to give yourself a free 60-day loan, it's generally a mistake to use 60-day rollovers rather than direct trustee-to-trustee rollovers. If the plan sends the money to you, it's required to withhold 20% of the taxable amount. If you later want to roll the entire amount of the original distribution over to an IRA, you'll need to use other sources to make up the 20% the plan withheld. In addition, there's no need to taunt the rollover gods by risking inadvertently violation of the 60-day limit. The fourth pitfall is remember the 10% penalty. Taxable distributions you receive from a 401k plan before age 59 and a half are normally subject to a 10% early distribution penalty. But a special rule lets you avoid the tax if you receive your distributions as a result of leaving your job during or after the year you turn age 55. But this special rule doesn't carry over for IRAs. If you roll your distribution over to an IRA, you'll need to wait until age 59 and a half before you can withdraw these dollars from the IRA without the 10% penalty, unless another exception applies. So if you think you may need to use your funds before age 59 and a half, a rollover to an IRA could be a costly mistake. Number 5 pitfall, learn about net unrealized appreciation, known as NUA. If your 401k plan distribution includes employer stock that's appreciated over the years, rolling that stock over into an IRA could be a serious mistake. Normally, distributions from 401k plans are subject to ordinary income taxes, but a special rule applies when you receive a distribution of employer stock from your plan. You pay ordinary income tax only on the cost of the stock at the time it was purchased for you by the plan. Any appreciation in the stock generally receives more favorable long-term capital gains treatment, regardless of how long you've owned the stock. Any additional appreciation after the stock is distributed to you is either long-term or short-term capital gains, depending on your holding period. These special NUA rules don't apply, again, do not apply if you roll the stock over to an IRA. Number 6 pitfall. And if you're rolling over Roth 401k dollars to a Roth IRA, that could be a problem. If you establish your first Roth IRA to accept a rollover of your Roth 401k dollars, you'll have to wait 5 more years until your distribution from the Roth IRA will be qualified and tax-free, regardless of whether or not you've met the 5-year requirement in your employer plan. So if you have a Roth 401k and you think at some point you might want to roll it into a Roth IRA, you might want to open one now so the clock starts ticking on the 5-year requirement as soon as possible. And again, this assumes you don't already have a Roth IRA. But caution when evaluating whether to initiate a rollover from an employer plan to an IRA, always be sure to 1, ask about possible surrender charges that may be imposed by your employer plan or new surrender charges that your IRA may impose. Number 2, compare investment fees and expenses charged by your IRA and investment funds with those charged by your employer plan, if any. And number 3, understand any accumulated rights or guarantees that you might be giving up by transferring funds out of your employer plan. Also, make sure you visit our website, www.cortburgretirement.com. Our site is filled with educational videos, ebooks, publications, and financial calculators designed to help you learn. Well, try that again. Designed to help you learn more about your finances. As you search our site, send us a note regarding any questions you may have about any particular investment concepts or products, and we will get back to you quickly with a thoughtful answer. I record these once a week, and I still get tripped up on it. Again, this is Miguel Gonzalez, certified retirement counselor and managing partner with Cortburg Retirement Advisors, signing off for this week's educational podcast.
The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Private Advisor Group, LLC, a registered investment advisor. Private Advisor Group, LLC, and Cortburg Retirement Advisors, Inc. are separate entities from LPL Financial. Investing involves risk, including possible loss of principal.